I have never shown my portfolio publicly, not once in the years I've been running this channel. Now today that changes because I'm showing you 3 positions that together make up close to half of my invested portfolio. So to give some context first, I have a 7-figure portfolio in my Interactive Brokers account, and the top 3 positions make up more than 50% of it. Anyway, for this video, I'm only showing my Interactive Brokers portfolio. I do have other portfolios in my CPF, SRS, and other accounts as well. But the biggest portfolio is still in Interactive Brokers. And I want to be very clear that this video is not financial advice. I'm just sharing my positions and my thinking behind all this. So I'm not telling you to copy me because the conviction cannot be borrowed. Let us be very clear on this. And by the end of this video, hopefully you can build your own portfolio based on your own mindsets, your thinking, and your conviction. And hi, if you're new here, my name is Chris, an ex-chartered accountant, now a personal finance YouTuber. And please help me follow my Instagram, only got 4,000 followers. And my first position in the top is SPYL. I has 19,340 units. So that is around $350,000, depending on the time you watch, the market value may fluctuate already. And this is in USD. So this is the S&P 500 UCITS ETF. So it tracks the S&P 500 index that is the top 500 companies by market cap listed and domiciled in the US. So it is nothing exotic. I think many people who follow my channel already know there's nothing really much to push about S&P 500 because it's like the standard template of most investors who are starting to look at US for growth instead of dividends in the Singapore market. So to give some background context, I actually started this position in 2024. That was after I fully liquidated my Singapore REITs portfolio. And it was a really big decision because in the past, I was very focused on cash flow investing, which means I was always about passive income. Every month, every quarter, there's dividend coming in. And you know, once your cash flow, your dividends go over your expenses, you're kind of financially free. So I was trapped in that mindset, correct? The income mindset. But over time, during the period, the REITs have been underperforming. And it is still underperforming right now. So I'm glad to have made the shift, the change to US market focusing on total returns instead. And we are no longer in a zero interest rate environment anymore. I really don't think REITs is the good play out there. So why SPYL exactly? There are so many ETFs. Why not a VUAA? Why not CSPX? Firstly, you will need an Ireland domiciled UCITS fund like SPYL or CSPX to avoid the estate tax plus a lower dividend withholding tax of 15%. I think that one I every time say already. But why not CSPX? Okay, CSPX is charges 0.07% expense ratio. So it's like more than 2 times more expensive than SPYL, which is only charging 0.03%. But the truth is that if you already hold CSPX, would I recommend you to switch to SPYL? I think there's no need to. To me, these 2 ETFs have very little differences. If you have already built a large position in CSPX, just continue building it. I think the savings itself is too small for you to just transfer and move everything over and then risk all this fluctuation in between. So the reason why I believe in S&P 500 long term was because it is a self-cleansing index, which means that those companies who perform will continue to stay at the top and they will continue to have their market cap increase and hence have a larger allocation to the portfolio. Whereas those who underperform or are not performing, they will get cleansed out of the index. And you should know recently that S&P rejected SpaceX to be included. So I think that was a very good move because SpaceX haven't proven themselves yet. So this is my top conviction pick, SPYL, but I'm not selling, neither am I buying anymore because I'm trying to diversify outside of US. And of course, there are risks to this ETF. Why? Because US dollar devaluation, you know, the de-dollarization thing, last year people keep talking about it. Now the exchange rate between USD and SGD kind of go back to history. So yeah, I don't know how this will play out. But the truth is that you will be over-concentrated in only US companies if you just invest in the S&P 500. And you are missing out very good companies outside of US that are listed. For example, like ASML, listed in the Netherlands, and also TSMC, listed in Taiwan. And this is the reason that brings me to my second largest position, which is VWRA, which is the Vanguard FTSE All-World UCITS ETF. And this is the accumulating fund version. If you want the distributing fund version, it is VWRD, but they just track the same index. So right now, my VWRA is around 200,000 US dollars. depending on the market value. And this is the current average price and unrealized profits, which is not a lot because I only started this position this year. This FTSE All-World UCITS ETF covers developed and emerging markets of the entire world, so not just US. So compared to my SPYL, which is really close to 3 years of holding, this one is a relatively new and younger position. The expense ratio of VWRA is 0.19%, which is much higher than SPYL, correct? But that is the cost of global diversification, because you have to give and take lah. If you want to diversify globally, naturally there will be more costs involved. So in the past, I was also in this position called ACWD. And ultimately, there comes to this question of ACWD versus VWRA, which one is better? So ACWD, the expense ratio is 0.12%, much lower than VWRA, but it tracks a relatively different index, and that is the MSCI All Country World Index. So why I chose VWRA eventually is because they have a larger assets under management, so it is slightly more liquid compared to ACWD. But the true performance difference is very small, so either one is good enough. Don't need to transfer your whole portfolio from one to the other just to save some costs. And there's another brother of VWRA called FWRA, even cheaper expense ratio at 0.15% per annum. So you could choose that if you want to focus on costs. Anyway, I went through all these all-world ETFs in my Ko-fi spreadsheet, which is available for free download. So you just have to click it, and it is totally free. Just that if you want to support the channel, you can also scan the IBKR code inside to help support me at zero additional cost. Thank you. Now, the real reason why I like VWRA is not because I think it will outperform my other counters. It's because I really don't need to think. I have 100% conviction in VWRA, even higher than SPYL, because it's global diversification. If I have excess cash, lump sum coming in, whether from bonus, commission, or you have suddenly high income coming in, then yes, I don't have to think and all go into VWRA. There's no analysis, there's no timing, there's no market guessing, just lump sum, which is perfect for my investment strategy, but it may not be your investment strategy, so just take it with a pinch of salt. Now, are there risks of holding VWRA? Of course, because you are diversified in the global world. If the US is dominant and growing so much faster than global companies, then of course you're missing out the growth if you compare S&P 500 versus VWRA. And whether the global exposure is a drag to your returns or not. But still, you're just paying for the diversification and for the risk management approach. Like, you are okay to take on less potential outsized returns as long as you're globally diversified. As long as you can accept this fact that you're paying for something like a small insurance, I think it is fine. So you need to have this mindset and thinking. So my third largest position is EIMI, which is around 160,000 US dollars as of the time of recording. It is an iShare called MSCI Emerging Markets IMI UCITS ETF, and it's pure emerging markets exposure. So if you want to overweight on developing economies like Taiwan, South Korea, India, China, Brazil, all this, right? Then I think this EM ETF is the one that you should look at. Now, the expense ratio is 0.18%, which is quite low for what you are getting. Like, you're getting diversified over 3,000 holdings across the emerging economies. And the top holdings are very familiar companies like TSMC from Taiwan and Samsung and SK Hynix from South Korea. All these names will be very familiar to you if you are into the AI and semiconductor space. And of course, I understand that EIMI is kind of overlapped with the VWRA exposure because VWRA has around 10% to EM markets, right? But the fact is that on long run valuations, the emerging markets have historically traded at lower valuations compared to developed markets. So you're kind of buying at a discount. So if you believe in mean reversion and demographic tailwinds, I think it's okay to add a little bit more emerging markets, but that's just my opinion. Especially if you believe in the Asia economy super growth in the next decade. But of course, this is a higher risk profile because, like I said, emerging markets are still emerging. They could go both ways. And it's highly volatile. They have currency risk, they have political risk, they also have geopolitical risk, and even liquidity risk. And Taiwan and Korea alone is around 50% of the index already. So it's like weighted towards these two economies. So this ETF will move on government policy and not just earnings from the companies alone. So yes, where can you buy all these ETF? It's not just any other broker because all these top 3 positions of my portfolio are listed in London Stock Exchange. So you want to buy SPYL, you want to buy VWRA, you want to buy EIMI, you can only go through a broker. that has London Stock Exchange access. And I highly recommend you to check out Interactive Brokers in this link here or scan the QR code here, because not all brokers can do that. And I like Interactive Brokers for their low foreign currency exchange fees and also access to all these UCITS ETF, which is tax advantage. So recommend you to check it out. I also have a bonus since you watched until here. My third largest position, I was supposed to talk about Google, GOOGL, which is around 100,000 US dollars. But ever since the price fell from all-time high of $400, yeah, EIMI just overtook it. And it is my only individual stock on this list. So as much as I want to share the conviction and my study behind Google, I really don't want MAS to invite me for kopi, for me to induce people and FOMO into buying Google. But anyway, Google was part of my starting positions when I was building during the bear market crash in 2022, because I saw that, oh, the price, it looks quite valuable. But I'm no longer adding position to individual stocks anyway, because I want to reduce idiosyncratic risk, which means that I don't want companies just because of one news or one earnings then just drop like 10% overnight. I just want to reduce that. And for most people, just like you and me, I think index funds and ETFs are the way to go, because you really don't need to worry so much. But like I said already, this video is really just for sharing. It is not financial advice, because I'm just showing you the facts and how you should think to build your own conviction when you are building your own portfolio. Remember, conviction cannot be borrowed. And if you want to go for index funds and ETFs listed in the London Stock Exchange, you have to go through a broker like Interactive Brokers. So for beginners, I always say it's best to start with an index fund so that you can learn the ropes first. Once you are more familiar, then you can go to explore stock picking yourself to allocate a small satellite position. Don't be like me, start from stock picking, then lose money already, then realize, oh, stock picking is not for me. I should just put into index funds and I even have a better return after that. So yes, I hope you like this video and press the like for this video. And if you want to look at my reasons for me to stop buying S&P 500, I already detailed a video right here and it already have more than 30,000 views. So check it out right here.